Good morning to everyone. Good morning, good afternoon, good evening, whatever it is always good. This is Sir Abil Ahmed, your mentor. Today is 15th Feb 2022, and this is page number 21 of our notes. In the last class, we completed Stella question. Stella was a past paper question, and now we are moving ahead. Spreading of employer's contribution. This is something new, in fact, in ATX. Very simple, straightforward. One thing we know that what is that thing? Actually, whatever employer contributes in pension plan for its employees, that is a deductible expense for the employer. If company is contributing in pension plan for their employees, so whatever they are contributing, it is allowable expense for the company, and company is going to deduct that amount from their trading profit. Now the new concept is, what if employer has increased his contribution in his contribution for the employee in pension plans? So if there's a massive increase in the contribution by the employer, then what to do? Where there is an increase in the level of employer's contribution from one period to the next over 210%. HMRC requires the tax relief to be spread evenly over the number of years. The first 110% is relieved in the current year. The excess is dealt as follows. Over 110%, less than £500,000, then all in the current year. All in the current year. If the contribution is in between 500,000 till 1 million, then it's spread evenly 2 years. Means employer is going to deduct from his two trading profits. If it is between 1 million and 2 million, then it's spread over 3 years. If it is more than 2 million, 2 million or more than 2, then spread evenly over 4 years. So additional contribution for existing pensioners are deductible when made. So it's very simple. If employer has increased contribution for his employee massively, then this rule applies. First 110% is relievable in the current year, and for over and above 110%, we have to see the amount. If the amount is less than 500,000, all will be deducted in the current year. If it is between 1 million 500,000 till 1 million, then spread it in only 2 years, and so on. So let's move ahead. Now we are discussing another very important topic, is accessing the pension. Accessing the pension means we just need to know that in UK, when an individual starts getting pension income, accessing the pension income, you need to know 2 to 3 things. Number one, simply when an individual starts getting pension income. Second, how do they get pension income? What are the tax rules when an individual gets pension income? Number one, in UK, the retirement age is 55 years. In last Finance Act 2020, it was 55 years. Still in Finance Act 2021, it is 55 years. So individual will not be able to get the pension funds until that individual reaches retirement age, which is 55 years. So individual will be able to get the pension income from 55 years onwards, provided that death of that individual does not prove earlier than 55 years. What do you mean by this? If someone is having a serious illness, and according to the doctors, that person will not reach 55 years. Let's say if someone is just 40 years old and that person is in severe illness, and according to the doctors, that person will not survive next 5 years. So in that case, pension income will be given to that individual even before the age of 55 years because he's not going to reach 55 according to the doctors. So this is an exception. If this happens, so obviously then 55 years does not matter. So otherwise, it is 55 years. Now, how do we get this pension funds? Look at this. When someone reaches on retirement age, on reaching pension age, which is 55 years, the individual may receive a tax-free lump sum, maximum 25% of lower of the value of the funds which is available. And the second point is lifetime allowance, lower of let's say 1 and 2. Lifetime allowance is 1,073,100. Assuming available funds are 800,000, okay? And let's say Mr. X has reached on retirement age. Mr. X has reached on retirement age, which is 55 years. And let me tell you one more thing. If someone reaches at 55 years age, then that individual starts getting pension income. But it is perfectly fine if that person still wants to work. He will be getting the pension income, don't worry. But after 55, if someone wants to work, it is perfectly fine. That person can work. Let's say Mr. X is the one who has reached the retirement age, 55 years, and assuming available funds are 800,000. So he's going to get 25% lump sum tax-free lower of this 1 and 2. So obviously he will be getting 25% of 800,000, which is 200,000. So this 200,000 Mr. X is going to get tax-free. Simply exempt, no tax at all. But still can I say 75%, which is 600,000 are still left. So 600,000, which is 75%. When Mr. X is going to take the remaining 75% funds, then according to HMRC, remaining 75% funds, when they will be taken as pension income by Mr. X, then remaining 75% will be treated as non-saving income and it is subject to 20, 40 or 45% tax. It depends on Mr. X tax paying status, but remaining 75% Mr. X can take obviously as and when required basis. So whenever he is going to take pension income from this remaining 600,000, so he has to pay tax either 20, 40 or 45. Depends on Mr. X tax paying status. Okay. Now the question is, what if available funds are more than the lifetime allowance? Let me tell you another example. Let's say now we have another individual, Mr. Y. Let's say Mr. Y also reaches on retirement age, and on retirement age, fund value is let's say 1.2 million and lifetime allowance is 1,073,100. Let's say Mr. Y is another individual who has reached retirement age. Fund value is 1.2 million and lifetime allowance is 1,073,100. On retirement age, he is going to get 25% lower of 1 and 2 tax free. So number one, this time tax free amount will be 25% of lifetime allowance. So we have to take 25% of this. Let me use a calculator. 1,073,100 into 25%. It is 2,68,275. Remaining 75%. If I take 75% of this amount, 1,073,100, if I take 75% of this, which is 804,825. So when Mr. Y is going to withdraw remaining 75% as and when required basis, then this 75% is subject to income tax 20, 40 and 45. Again depends on Mr. Y's tax paying status. Now the question is, so what about this excess funds? Because Mr. Y is having the fund value more than the lifetime allowance. And so far you have only explained each and everything by taking the lifetime allowance. What about this excess amount? Okay, now listen carefully. If Mr. X takes the excess amount over and above the lifetime allowance lump sum, then he has to pay 55% tax. Let's say case A, Mr. Y takes excess amount lump sum. Then what happens? Let me first write the excess amount. Fund value is 1.2 million. I need to deduct lifetime allowance. So here comes the excess amount, which is 1,26,900. There is going to be charge, excess amount charge, you can simply say tax 55%. I have to take 55% of this, which is 69,795. So logically, Mr. Y is going to get 57,105. Logically, Mr. Y will get this amount. So if Mr. Y takes excess amount lump sum, then HMRC will give him a gift. The gift is he has to pay 55% charge. Wow. So logically, Mr. Y will be getting 57,105. Case B. Let's say Mr. Y says, I'm going to take excess amount in the form of larger annuities. Question, what do you mean by larger annuities? A larger annuities means, let's say he's going to get the excess amount in the next 3 years, 4 years, could be 2 years, could be 5 years. But he's not going to take the excess amount lump sum, because if he takes the excess amount lump sum, then he has to pay 55%. So if he takes excess amount in the form of larger annuities, then he has to pay income tax 25%. If he withdraws the excess amount in the form of annuity, larger annuities, then there is going to be a tax of 25%, which means excess amount 1.2 million minus lifetime allowance. The excess amount is 1,26,900. So when this excess is going to be withdrawn in the form of larger annuities, let's say it could be over 3 years, 4 years, then he has to pay 25% tax. So there is going to be 25% tax. So 126,900, if I take 25% of this, 31,725. So how much actually Mr. Y is going to get? 95,175. Now let me clear one thing. Mr. Y is not paying 31,725 tax at once. Basically, whenever he is going to withdraw excess amount 1,26,900 in next could be 2 years, 3 years, 5 years time. So whatever amount he is going to withdraw from this 1,26,900, he has to pay 25% tax on that amount. If he needs entire 1,26,900 lump sum, then he has to pay 55%. So now I strongly believe you people have understood. If at the time of retirement individual is having a fund which is more than lifetime allowance, then what to do? Look at this. Lifetime allowance is this. If fund exceeds lifetime allowance, excess is to be used to fund a larger annuity. The tax charge is going to be 25%. Where taxpayer chooses to take excess in, then the tax charge is going to be 55% on excess amount. If taxpayer chooses to take the excess in cash, means lump sum. If he takes lump sum excess amount, then he has to pay 55% tax. Question 18. Ty was 64 years on 16 August 2021 and decided to take his pension benefit on that date. Okay. Even though Ty was eligible to get from 55 years age, he had a money purchase pension fund which was valued 2.7 million. Wow. Far more than annual allowance limit. Far more than the lifetime allowance limit, not the annual allowance. Lifetime allowance limit, which is 1,073,100 on 16 August 2021. Ty took the maximum tax-free lump sum, which is 25% lower of fund available and lifetime allowance. The balance up to the lifetime allowance was vested, provide pension income benefits. Show the tax consequences if Ty takes the excess fund as lump sum. If Ty takes excess amount, which is excess then lifetime allowance, if he takes lump sum, obviously he has to pay 55% tax charge. Ty takes excess fund to buy pension income, means slowly and gradually she takes excess funds, then there is going to be a tax of 25%. Now what I want you people to do it, just pause the video, solve question number 18, and then obviously you can unpause the video. Let us try part A. I strongly believe that you have tried this. Part A, number 1, tax free is 25%, lower of 1 and 2. One is fund value, which is 2.7 million. Lifetime allowance 1,073,100. Fund value is 2.7 million. Lifetime allowance is this, obviously lower of these two. So 25% of this. Tax free amount is, I have to take 25% of this amount. 2,68,275. Remaining 75%. 1,073,100. If I take 75% of this, it is 804,825. You have to just explain your examiner. The remaining amount when Ty is going to take as and when required basis. This amount is subject to 20, 40 and even 45%. depends on Thai tax paying status in the year in which Thai takes this amount. Thai takes amount from this remaining 804,825. So when Thai is going to take 75% amount as and when required basis, could be over 10 years, 5 years, 20 years, it's up to him. Then he has to pay tax 20, 40 or 45%. Now let's talk about excess. In part A, it says Thai takes excess funds as lump sum. If Thai takes excess fund lump sum, then he has to pay tax charge 55%. Excess amount 2.7 million. We need to deduct lifetime allowance, which is 1,73,100. From this 2.7 million, I need to deduct lifetime allowance, which is 1,006 lakh, 1.6 million to 6,900. Okay. 55% tax charge because Thai is taking lump sum 89475. So here comes the amount which Thai is going to get. Thai will get 1,626,900, 7,32,105. So let me check once all the arithmetics so that there should not be any issue. That's great. So I strongly believe that you had the same answer, or you are having the same answer. In part B, what it says, excess fund to buy pension income. If she takes excess funds, let's say slowly and gradually, then she has to pay 25%. So in part B, excess amount is same, 1,626,900, but tax charge is only 25%. 1,626,900. 1,626,900. We have to take 25% of this. 406,725. 1,626,900. 1,220,175. So in part B, Thai is going to get 1,220,175 if she is not taking excess amount lump sum. So we should advise Thai. If you want to go for lump sum, then you have to pay 55%, otherwise 25%. So obviously Thai is the one who has to decide. So I believe you are having the same answer. Now let's discuss a very small and important topic, that is NIC, National Insurance Contribution. Basically, every individual in UK who is working, that individual needs to pay NIC. Look at the name, National Insurance Contribution. So every individual who is working in UK needs to pay NIC. It is the state-funded pension plan, but every individual makes contribution into it. Self-employed individual actually pays class 2 and class 4 NIC. Self-employed individual pays class 2 and class 4 NIC. How do they pay? We will discuss. Just wait for a minute. Class 2, class 4 NIC both are applicable on trading income after deducting trading losses. What do you mean by this? For example, if you are having tax adjusted trading profit as well as loss. So from tax adjusted trading profit, first you need to deduct the loss. Then whatever is left on that profit you have to pay class 2 and 4 NIC. How do we pay? What are the tax rates? We'll discuss that. And the good thing is all the rates of NIC will be given to you in exam. But right now you just need to know one thing. Self-employed individual, they basically pay class 2 and class 4 NIC. And class 2 and 4 NIC both are applicable on trading income after deducting what? trading losses. Now let's talk about employment. Let me explain this over here. First, I'm discussing NICs relating to employment, then I'll come back to self-employed, don't worry. Let's talk about employment. Employment income. Employee pays class 1 employees NIC on cash benefits. Okay. Employee pays class 1 employees NIC on cash benefits. Question is, what do you mean by cash benefits? Example of cash benefit is salary. Another example is bonus. Another example is, if employee is getting excess authorized mileage allowance, excess than 45 pence per mile. Excess authorized mileage allowance means more than 45 pence per mile. What do you mean by this? We'll be discussing in basic employment income as well, but let me give you an idea. For example, uh, an employee uses his car for employment purposes, then normally what happens? Employer reimburses that employee. Let's say Mr. X has driven, assuming 10,000 miles, his car for employment purposes. Assuming Mr. X has driven 10,000 miles his car for employment purposes, and his employer has reimbursed him 60 pence per mile. His employer has reimbursed him 60 pence per mile. In that case, in cash benefits, we have to take only 15 pence. Because the rule says if you are getting over and above 45 pence per mile, only excess than 45 pence per mile will be treated as cash benefits. So in my example, Mr. X is getting 16 pence, which is obviously 15 pence over and above 45. So if I calculate here excess authorized mileage allowance, so I'm going to take 10,000 miles into 15 pence. 15 pence means 0.15. So simply I'll be getting 1500. So this 1500 is your cash benefit. So I strongly believe now you have understood what do you mean by excess and 45 pence per mile. So on cash benefits, employee will have to pay class 1 NIC. Examples of cash benefits are number 1 salary, number 2 bonus, and third one is excess authorized mileage allowance. If individual gets more than 45 pence per mile, then only additional than 45 pence per mile will be treated as cash benefits. Like in my example, Mr. X was getting 60 pence, so 15 pence per mile I have taken as cash benefits. Okay. So what are the NIC rates for class 1 employee NIC? We'll be discussing this. Just wait for a minute. Employer also pays class 1 employers NIC on cash benefits. And what are the examples of cash benefits? Salary, bonus, excess mileage allowance. Excess than 45 pence per mile. So employer also pays class 1 employer NIC on cash benefits. What are the rates we are just discussing? Don't worry, just wait for a minute, and these rates will be given to you in exam as well. Okay. employer needs to pay class 1A employers NIC on non-cash benefits. For example, car benefit, for example, accommodation benefit, for example, beneficial loan benefit, and there are so many other benefits we'll be discussing inshallah. So actually, in case of employment, employer will have to pay two NICs. Employer class 1 NIC which is paid on cash benefit. Employer class 1A NIC which is paid on non-cash benefits. But good thing for the employer is class 1 employer NIC as well as class 1A employer NIC, they are deductible expenses for the employer. Employer can deduct these payments, these NIC payments from their trading profit. So employer class 1 NIC and employer class 1A NIC will be deducted from the trading profit of the employer. When it comes to employee, employee only pays class 1 employee NIC, and that NIC payment employee cannot deduct from anywhere. So employee just has to pay, that's it. Now let us see what are the rates, and these rates will be given to you in exam, don't worry. Class 1 employee, from 1 till 9568 it is nil, 9569 till 50270 it is 12%. When you go over and above 50271 and above, then it is 2%. Class 1 employee NIC. For example, let's say Mr. X is having salary of 80,000. Salary is a cash benefit, yes. We just need to calculate, let's say, class 1 employee NIC. So how do we calculate? Class 1 employee NIC. 9568 into 0% results 0. 50270 minus 9568 into 12%. Let me use my calculator. 50270 minus 9568 into 12%, it is 4,884. Now 80,000 minus 50270 into 2%. 80 minus 50270 into 2%. It is coming 594.6. So I'm taking it 595. So here comes your class 1 employee NIC liability. Class 1 employees NIC liability. 484 plus 595 gives me 5,479. Now let's talk about employer. Class 1 employer NIC. Till 8840 per year, per employee is nil. 8841 and above, it is 13.8%. What do you mean by employment allowance? I would say just wait for 1 minute. That's it. Then I'll explain you inshallah. Class 1 employer NIC, 8840 till 8840 it is nil. Over and above 8840 it is 13.8%. So let's calculate. Class 1 employer NIC. 80,000, just deduct 8840 if I'm not wrong. Yes. Because first 8840 it is 0%. Then you have to take 13.8%. So 80,000 minus 8840 into 13.8. So we are getting 9,820. Okay. This is class 1 employer NIC. Class 1 employer NIC. Now listen and listen carefully. Employer, they get, employers, they get 4,000 pound employment allowance only on class 1 employer NIC per tax year, not per employee. Repeat. Employers, they get employment allowance of 4,000 pound against their class 1 employer NIC, and this 4,000 is available per tax year, it is not available per employee. So let us deduct employment allowance, assuming it was not used before in the tax year, so which means 5820. So class 1 employer's NIC liability will be 5,820, which means that employer is going to deduct 5,820 from his or her trading profit. If I talk about a company, company is going to deduct 5,820 from their trading profit. This 4,000 employment allowance is only available against class 1 employer NIC. Okay, so when it comes to the past paper questions, your examiner will mention in the question either employment allowance has been used or not. So don't worry for that. Right now you just need to know one thing. What is that? Class 1 employer NIC gets employment allowance of 4,000 pound as well. But there is one more concept. What is that? If in the entire organization there is one director and that director is the only employee of the company, then 4,000 employment allowance is not available. Repeat. If in the entire organization there is one director and he is the only employee of that company, in that case 4,000 employment allowance will not be available. Okay. Class 1A is very simple. Whatever is the non-cash benefit amount, just apply 13.8%. Class 1A NIC is straightforward. Whatever is the non-cash benefit, just apply 13.8% on that amount. You will get class 1A NIC. Okay. And 4,000 employment allowance. Employment allowance which is given to employer is 4,000 per tax year on class 1 employer, only on cash benefit. The employment allowance is not available to companies where director is the sole employee. Now let's talk about class 2 and class 4 NICs for self-employed individual. Class 2, self-employed person will have to pay 3.05 per week. But this will only be paid when small profit threshold is 6,515. Means your profit, your tax adjusted profit after deducting the losses if you have must be more than 6,515. If the amount of the profit is less than 6,515, then you're not supposed to pay class 2 NIC. Repeat, class 2 NIC is only paid when amount of the profit after deducting losses if we have is more than 6,515. Class 4 NIC is paid on trading profit after deducting the losses. 9568 it is nil, then it is 9% and 2%. It is exactly like class 1 employee NIC, only the difference is this 9%. Rest is same. For example, let's say in current tax year, we have tax adjusted trading profit, let's say 90,000. We have brought forward trading losses, tax adjusted trading loss. This is tax adjusted trading profit. and this is tax adjusted trading loss brought forward, which is 20,000. I'm going to deduct this, so I'm left with 70. And my examiner is asking calculate class 2 and class 4 NIC. I have to pay class 2 NIC because this is far more than a small threshold profit limit, which is 6,515. So class 2 is paid 3.05 per week. Just multiply this with 52. 3.05 into 52 results in, I'm getting answer 158.6. So let me write 159. Now let's talk about class 4 NIC. 9568, I'll get 0. After that, 50270 minus 9568 into 9%. 50, it is 0. 270 minus 9568 into 9%. 50270 minus 9568 into 9%. I'm getting 3603. 70 minus 50270 into 2%. 50270 into 2%. I'm getting 394.6, so let me write 395. So here comes your class 4 NIC liability. It is 4058. Class 4 NIC liability. Class 4 NIC liability. Question, sir, what if we did not have this 20,000 loss? Then obviously then you would have paid class 4 NIC on 90,000. In the absence of loss, obviously you were supposed to pay class 4 NIC on this 90,000. But since we had a loss, so we are supposed to first deduct the loss, then on remaining profit, we have to pay class 4 NIC. In the absence of the loss, obviously the entire calculation would be done on this 90,000. So that was all about NICs. So this is the end of our lecture today. Inshallah, from the next class, we are going to start our employment income. I'll be starting my employment income. We'll be starting our employment income from basic employment, and then slowly and gradually we'll go to share options and termination benefits. But so far so good. So far we have discussed one kit question, that is Stella. But after maybe 1 or 2 more lectures, or maybe 3 lectures, we'll be started solving other kit questions as well. So thank you very much. Have a nice day watching my lecture.